So I'm going to take some time to explain the modern monetary policy, which is the new buzzword which is coming around, and I'm trying to just explain it to you from a layman's perspective. So first, we got to understand what is a regular monetary policy. Now, regular monetary policy is where the government has a pie, and the way the government increases that pie is through two methods. So one is it charges an amount of debt, okay, and the second one is it charges an amount of taxes. Now the taxes are in the form of income tax, which is both income as well as indirect taxes. So that's a regular monetary policy, and there's a limit to it because the government cannot increase taxes beyond a limit, and the debt is dependent on the overall ability of the government's ability to take money from the market. Okay, and then there is another body which controls the inflation, which is called the Reserve Bank of the country, and the Reserve Bank of the country basically dictates your ability to change the interest rates. So the government part of um, the system of governance controls the fiscal policy. It's called the fiscal policy. And the Reserve Bank of the country or the Federal Bank of the country decides the monetary policy. So monetary policy is nothing but interest coverage. So it allows what interest needs to be given, not given, and so on and so forth. So for example, let's say a country X has a Reserve Bank, and it is called whatever it is, okay, and it's got it issues a 7% interest rates to all other banks. So every bank in the country will have to adhere to at least 7% of interest, which is to say it cannot give anybody less than 7% interest. It has to give at least 7% interest to people, and typically, bank will only charge what the Reserve Bank of that country tells it to charge. It's called because there is also banking rules which say that you have to maintain something called as a CRR, cash reserve ratio. So there are many things, and the bank will more or less have very little play on its own part to increase this percentage decided by the Reserve Bank of the country. Now the Reserve Bank of the country decides that because it decides that on the basis of inflation. So if the inflation is going high, it will increase the interest rate. So if the interest rate is increased, more people will invest in banks, and the overall money supply will reduce, and thus the inflation will come down. And if the inflation is down and the unemployment is less, then it will decrease the overall interest rate, which means the money can be spent. People will give that money into their business, or they will spend that money into some sort of other capital expenditure. For example, say they want to spend it for so housing, business, and so on and so forth, and people will keep that money less in the bank because the interest rates is so low that there is no point keeping that money in bank. So that's how the economy is indirectly controlled by the Reserve Bank from a money supply point of view, and the government controls it from a money expenditure point of view, which is the taxes and debt which it has. So the government basically uses this kitty to do road constructions, to do infrastructure, to do education, to do healthcare and subsidy and development programs, and so on and so forth. But the biggest issue in this entire framework is something called as debt, and because the taxes can only be increased to a certain extent, debt can debt is the one which keeps going up because the government borrowing keep going up. Now the modern monetary policy says that this is really not a problem, and debt can be increased as long as the government wants, because the government end of the day prints money, and the government is only the sovereign which has the ability to print money. So because it has the ability to print money, it can take on more debt. So it can increase this kitty basically. And what would happen is the money supply will increase in the country, which would increase this inflation. Okay, so instead of the Reserve Bank of that country changing the interest rate, through and reducing the interest rate, and then controlling the economy. The government can raise taxes if the economy overheats on to certain sections of the society, and this also comes to play because today the inequality quotient says that 1% of the population today in the world owns close to 60% of the assets in terms of capital. So they are saying they will charge taxing the super rich more, this portion, but they will not charge the lower segment of the society. Okay, they will charge the super rich of the pyramid. Okay, the top of the cream de la cream guys who own 60% of wealth any which ways, and through that taxation they will reduce the money supply, because these are the guys who are capital rich, so they will sort of not invest all that money back into business if the interest rates are going high or whatever it is. So it's kind of that kind of complicated way of doing it. But the con of this particular issue is that what if the government goes on overdrive? What if the government needs to spend X amount of money onto some infrastructure development program or some developmental program, and the government is really notorious in terms of spending because they want votes and they want vote bank, and they would just go ahead and spend it and say we don't care about the fiscal policy, and let's just worry about it in the next election, after the next election. So because in democracy the elections are only 4 to 5 years long, so they typically, the government is only 4 to 5 years long, so typically they don't have a long-term horizon in terms of view. So what they're saying is that to do this particular change of increase of debt and taxation, instead of the government coming into play, okay, we will use the parliament. The parliament, because it is a more homogeneous body, there are a lot of other special interest groups which are involved. Different actors play a very important role play here, and because a parliament is more diverse than the government and it could have several interests, so it may not always agree to a increasing of debt through this means. So this is the sort of answer given by the economist on modern monetary policy. But it needs to be seen how this sort of plays out, because end of the day debt is not good to anybody. So if you're holding a debt of, let's say, X amount in your bank, you have to pay regular interest. But here the logic is because the government prints money, they don't really have to worry about paying debt. They can keep increasing the value. The last con here is really the impact of your currency in terms of foreign exchange. So let's say if your dollar is rated X in the market, and this is really happening in the US, because the US believes that it's got a reserve currency, it can play around a little more than necessary. But if US has a reserve currency, and if another country tries to follow this which doesn't have a reserve currency, in the international market, the value of your money will go drastically down. The value of your money, what you can buy with one rupee or 1 yen, can go drastically down because this is going to impact the other people are going to move out of your money and move it into other currencies. So that may eventually come to bite you here again, in your debt. So though your debt you may be able to take a higher debt, the repayment will also become higher because the value of your overall currency has come down. So it needs to be seen how this entire thing plays out. What are the modalities of this entire monetary policy? But it is quite a fan favorite in terms of how politicians want to play it, because this allows them access to free money, and politicians like free money. So that's monetary policy, modern monetary policy, and how it works. So thank you. Have a great day.